I'm going to go ahead and call this meeting to order. And we do have a quorum. We are missing a few. I don't see Dr. Ellis, and I don't see Mr. Hickman. So we do have a quorum, and so we will call this meeting to order. It is
10:03.
10:03. Well, a little late. So, all right. First item of business is the minutes of the February 19th, 2026 meeting. Is there a motion to adopt the minutes?
This board approve the minutes of February 19th, 2026 meeting of the Texas Department of School Fund Corporation Board as provided.
All right. Is there a second?
Second.
All right. Got a motion and a second. Are there any additions or corrections to the minutes? Any objections? No objections, motion carries, and it is adopted. Now I'm gonna throw a little bit of a curveball to y'all. Mr. Borden, we are going to actually move item number 7 up. And we're going to go ahead and we're going to adjourn to executive session. And so at this time, the Board of Directors of the Texas Permanent School Fund Corporation will hold a closed session for May 14th, 2026 meeting for the purpose of Agenda 5 to
Item 7.
It is item 7.
Yes, sir.
To discuss personal matters related to the Chief Executive Officer and the Government Code Section 551.071 and 551.074 to deliberate personal matters and consult with legal counsel as needed. The closed session will be held in the Legacy Boardroom from 7:55 here in this building. The meeting will resume upon the conclusion of the closed session. The time is now
It is 10:05, sir.
10:05. All right. So board members, we are going to go ahead and adjourn to Legacy right next door. Okay, we are back. Just first, before we reconvene, just as a clarification, the executive session was on item 5. We had a little bit of a misprint in the agenda, and so that was item 5. And so closed session of the Board of Directors of the Texas Permanent School Fund Corporation on May 14th, 2026 is now ended. And the board is now in open session. And the time is
It is 10:52.
10:52. No action was taken by the board in closed session. However, I will go ahead now and get a motion from Mr. Wright.
And Mr. Chairman, technically, we need people on camera if we're having a vote. We need
Okay.
cameras on.
Okay, need all cameras on, please. Ms. Perez-Diaz. Okay, Mr. Wright.
I move that the board approve the recommendation of the Budget and Compensation Committee regarding the Chief Executive Officer.
Okay. Second. Third. Okay. Any further discussion? Any discussion surrounding regarding the motion? Is there any objection to the motion? Objection, let the record show that motion is carries unanimously. And Mr. Borden, we'll have a little bit of discussion after the meeting, and Brad will kind of update you on all of that. Okay. So let's return to the agenda, and just full disclosure that I have a scheduling conflict that I couldn't resolve, and so I'm about to hand off the reins to Brad, and then I'm gonna go remote. but I will still be in the meeting. I did want to go ahead and skip down to item number 9, and that is the report related to the board self-assessment. And if I can get Lane to just brief, this is not an action item, it's just information. If I can get you to just to comment on that, and then I'm going to follow up briefly.
Yes, sir. Happy to. It's begins on page 97 in the diligent materials. So what we did is we had a 15-question survey, Likert scale 1 through 5, 5 being good, on 4 discrete topics, which were governance and oversight, board structure and meeting process, board relationships and relationships with CEO. And when we took and reviewed the results 2 different ways, we had an average of 4. So if you average the score to each of the 15 questions, the average is 4. If you take the same median value, it's a 5. So those are pretty good scores. There was an opportunity to provide written feedback, and the feedback that was provided was very, very positive. And we noticed a trend of multiple directors suggesting that some education and training in a more formalized way would be beneficial.
And I just want to comment on that is that I think that's kind of a recurring theme, and given that we have a board that comes from a myriad of different backgrounds and varying degrees of knowledge regarding investment and that sort of thing. Red Humphreys and I had a conversation yesterday a little bit about, being more strategic about that and creating an onboarding process, a very, very intentional onboarding process, and maybe even creating sort of a list of things is that, and what is the ideal? That ideally every board member should know and understand what, as it relates to investments and stuff like that, but also governance, and just public education in general, and that sort of thing. And then essentially then we can create I hate to use the word IEP, and individual education, special education, like that, but I mean, that's essentially what it is, an individual training plan that we can be very intentional about doing and make sure that every board member feels like they're fully equipped to fully engage in the process. And so that's kind of some thought process. Did you want to kind of comment on that briefly?
Yeah, so we've talked about what was really going to be an exhaustive list, an inventory, if you will, of not just investment stuff. We've already gotten with the staff, some of the staff members on this, because the topic's broad and it takes more than one person.
Good. Any comments about that? If you've got any other comments regarding that evaluation, and I'd be happy to have that conversation for you. Okay. This time I'm gonna hand off the presiding officer duties to Vice Chairman Brad Wright, and I'm gonna step into the remote room.
I humbly accept the handoff. Not sure I have quite the extensive joke set, but I think we're turning it over to Bob, the CEO.
Yes, sir.
Thank you.
CEO comments today. We really want to center on a couple of things, a preview of the PSF distributions, particularly the 5A distribution, that we will be starting the process to communicate this to the Board of Education next month. So want to make sure that the corporate board members are apprised of what we are intending to present. We will present that over the course of multiple meetings for the rest of this year. Also a preview of our appropriations requests that will be in front of you in your third quarter meeting for final approval. The details on the distribution rate I'll get to in a minute, but I want to stop on our vision page for a moment. Our vision page is to be a magnet for exceptional talent, be a leader in endowment management, a partner of Texas universities, corporations, and industries, and of course, a source of perpetual and increasing funding for education. A couple of highlights on the magnet for exceptional talent. Everyone is aware that we recruited an exceptional general counsel and chief operating officer, but I also wanted to introduce one of our newest recruits, Mr. Chris Eckerman, who's with us today. Chris joins us as the head of co-investments and direct investments. And he was last at the State of Wisconsin Investment Board for the last 12 years, where he developed their venture and co-investment program. He's got a background in the venture capital industry, and is also a UT MBA and former member of the UT swim team as well. So, well, Chris, welcome aboard. Being a leader in endowment management, I think one of the things we're seeing in our LAR is we continue to look to be the low-cost provider for investment management in the state, and I would say probably nationally at below 10 basis points for our all-in cost of overseeing this fund. But in terms of a presence in the industry as a leader, I want to recognize our head of credit, John Newell, who is going to be presenting to you all later today on our overview of the private equity program. But he was just named by Institutional Investor as one of their 2026 rising stars. That is really a national recognition of what he's doing in this credit program and the fund as well. In our vision of being a partner with our local universities, we've talked a lot about our engagement in the internship program, but I want you to know that your chief risk officer sitting next to me, Mr. Jared Stout, has now been named a member of the McCoy College of Business Foundation at Texas State University, helping oversee their endowment. So good presence that we're having, and I think just seeing our vision in action. I want to talk a little bit about the investment performance and the state of the economy. As you all know, we've got a lot of volatility these days, particularly centered around the conflict in the Gulf and the Strait of Hormuz. But oddly backdropped by a stock market that is setting new highs. In fact, when this full shock of the system happened in the initial engagement in Iran, the market sold off over 10%, which kind of qualifies what economists will officially call a correction. And this is the fastest time in history after a correction that a market has gone back and set a new record high by a large margin. So it's just an example of the kind of volatility that we're facing. Now, as this conflict drags on, there's a real squeeze on the global oil supply. Importing nations that can't get any are exhausting their storage capacity and using their reserves by a variety of measures. Some of those countries, particularly in Asia, are on the precipice of exhausting those reserves, and there's going to be a real shortage of the commodity on the ground. And a lot of the exporting nations are backed up with production that they can't move. So even if we get a resolution to this conflict, the backlog of resetting the system of supply and demand and shock absorbers that every country has a certain amount of oil in reserve, and a lot of exporting companies have a lot of oil on deck in storage at ports ready to go. That imbalance will take months to clear and reset, and it bears watching because it will have possibly an impact on in sustained inflation and therefore our portfolio. But we continue to have real GDP growth. Corporate earnings continue to look strong, and some surprises to the upside. At the same time, we have the spike in inflation caused by this gridlock in the oil markets, and a bit of a mixed bag in the labor markets. I think it's characterized as a low hire, low fire environment. It's just kind of going sideways in the state. Our performance in the plan continues to stay strong, and in fact, a very strong year last year. This is as the final numbers as of 12/31. Well, almost 11.5% return in the portfolio versus our benchmark, policy benchmark of 11. And the 3-year number at 9.4 versus 8.9. I continue to think this is an extraordinary accomplishment, given the fact that we moved about 30 billion of the assets, which is a $60 billion round trip, and the frictional costs of selling portfolios and buying new portfolios and holding things in cash could have had a pretty detrimental effect on our returns, but this team managed it very, very well. And we did a massive transition without really too much disruption to our asset allocation and our risk posturing, which has allowed us to maintain the performance that we're seeking. As we measure our performance related to peers, we have a desire to be kind of in this third quartile, above median, but living between the second and third quartile, where we can maybe consistently stay there. We're there today. The biggest piece of information that we have to deliver to the legislature by the end of the year is what the final approved 5A endowment spending rate will be. That final approval authority lies with the Board of Education, but it's based on our recommendations. And as a refresher to all of you, there's a constitutional limit that cannot be higher than 6% of our portfolio. There's a constitutionally prescribed 10-year test that I'll show later that we have to be able to pass. That is really a test on the sustainability of our spending rate, that our spending rate over 10 years cannot outpace our growth rate over the 10 years. And when we come up with this spending rate, it's applied to a trailing 16-quarter asset base, also designed to kind of smooth the volatility. We're going to have the first recommendation of that to the Board of Education. I'll go over the calendar in a moment. Separately, in August, we will approve as a corporation the 5G supplemental distribution that is constitutionally maxed at $600 million a year. The next page just shows you where we're at currently on these two. In the prior biennium, the distribution was set to 1.81 billion per year, or 3.6 billion for the biennium. It combined with the 5G distribution, it's 4.8 billion in the biennium that we have distributed and are in the process of still distributing throughout 26 and 27. And we'll be resetting a rate for the biennium for fiscal years 2028 and 2029. This calendar that follows a lot of steps that happen here. There'll be 3 different trips to the Board of Education starting in June. As I said, we will adopt the 5G spending rate in August. We have to determine that these constitutional tests are met in early September. And we've got a little bit of chicken and egg thing going on. One of the inputs that we will use in this model is student population growth rate. The final projections of that from the TEA are usually not released till October. We will be fine-tuning our recommendation as those data points come out. By November 1st, we have to report to the legislature what the intended distribution is, but the final approval of that lies with the SBOE in their November meeting. So I'll point out some things that are worth watching between now and then. On the next page is our first cut of how the math is looking. I'll just draw your attention to the central column. Our expected return of our portfolio. As you know, we adopted a revised asset allocation targets and revised earnings assumptions. We have an expected return of 6.4% nominal on the total portfolio. To have a real sustainable purchasing power, we do 2 things. We adjust for inflation expectations and student population growth. So we subtract from our return what we think the expected long-term rate of inflation is. Right now, we're using 2.5%. More on that in a moment. That gives us our real return. And we subtract from that student population growth and administrative expenses. I said the administrative expenses are very, very stable and falling. The student population growth bears a lot more scrutiny, as there's been some clear trends developing in really shrinking public student population. And since that is a subtraction, if you're actually going to have a shrinking number, it becomes an add back to your spending rate. So right now we're framing this as 3.45%, which is coincidentally what we used in the last biennium. However, we're applying that to a larger asset base. So the dollar amounts are a little higher. And then you'll see that in the bottom right-hand corner here, an incremental 200 million per year on the 5A. Of course, 5G was already at its max. So 200 million per year, or 400 million for the biennium. So that's the first cut of this. I'm not going to talk about our capital market expectations. I think we've discussed that recently, but the short-term inflation expectations bear discussion. We look at the forward curves of inflation expectations as set by the market, highly efficient market that trades a lot of contracts around inflation rates. So it's pretty informative about what the entire investment world thinks inflation will look like 1 year, 3 or 5 years, 10 years out. This green line shows where we were sitting prior to the conflict in the Middle East. And it was almost a flat line. I mean, inflation, the whole world was basically thinking inflation is just stable and flat at around 2.5%, call it in the long end. After the shock to the markets with this action in the Mideast, you see the short-term inflation shot up significantly to over almost like 3.25%. But the long-term expectations out of 10-year were actually unchanged and slightly lower in 30 years. What this tells me is the market thinks that this conflict will be resolved in a reasonably short period of time, and that this supply chain imbalance will work its way out over the course of several months, maybe a year or two, and therefore higher inflation in the short term because of the squeeze, but it settles back down to a long-term average. Hopefully, we see this pattern stabilize between now and November. If we see long-term inflation creeping up substantially, we may have to revise our estimates. So this is just something to keep an eye on. Student population growth, I said the trend has been kind of interesting. If you look at this chart, you see the actual daily attendance by the blue line is kind of all over the place. Of course, you had the COVID shock, which we all know why, but then there was a big rebound from that. But now a real trend that there's a lot of moving parts going on demographics of how many people are coming into the state with school-age children, how many people are using private schools, et cetera. We have found actually, in addition to TEA, Texas 2036, which is a very thoughtful research entity that helps the state with public policy, does longer term demographic projections that include student population growth. So we've been availing ourselves of those numbers. They indicate to me in a variety of ways that we could probably easily assume a flat 0 for student population growth and have a lot of data to support that. So that might be an offset. If we have a little bit higher inflation, we probably can rationalize and underwrite slightly lower student population. The 10-year test that we have to adhere to, again, is simply a sustainability test that the legislature came up with. I think it's very common sense. It just basically says your cumulative 10-year spending can't outstrip your growth rate of your plan. Because if it is, it indicates you're overspending and shrinking the plan. And so there's a test that shows that. And right now, the probability of us failing that test is less than 1%. And even as we go out into the future years, we actually lose some of the really positive years behind us, but it's still a sub 2% probability. So very low probability, but it's something that we have to constantly re-underwrite. To put it in other terms that it's easier to understand is the drawdown. If you look above it, 27.4% or 29.3%. That's how much of a crash in the market in our portfolio we would have to sustain before we have to tap the brakes and cease making distributions. That has happened before in the past, just episodically, and it could happen. But you can see that that's a massive. If our portfolio is down 30%, the world has got all kinds of issues, and it won't be a PSF centric issue. So that's how the recommendation on 5A is laying out. We will revisit this with the board again in August and again at the end of the year. I will keep the board updated between their August and December meeting as these other data points come about. So everyone should be on the same page here. But if all goes well, hopefully we're in a posture to recommend an increased distribution to the 5A mechanism into the available school fund, and that the Board of Education sees fit to adopt that recommendation. At this point, I'd like to just touch on a couple of budget items, but I can't. Does anyone have any question or comment about the spending rate? Okay. If I could, Mr. Chairman, I want to invite our CFO, Mike Meyer, just to say a couple of words and big picture of where our budget is falling out. We will not know exactly what the LAR looks like until we get base budget numbers released by the legislature sometime in June, July, but by the August meeting, we will have all of those final, and it will be in front of you for consideration and approval. This is just a sneak preview.
Thanks, Bob. As Bob said, we'll bring you final recommendations for our appropriations request in August. That's the resources we'll need for the 2-year period starting September 1st, 2027. We've gone through a pretty robust process to forecast out our expenses during that period, and just want to talk you through kind of the framework that we're looking at. This has been reviewed in detail with the Budget and Comp Committee, but wanted to give you a preview so that when we come to you in August, you'll have a better sense of where we're going to land. We kind of gave some bookends here for you to think about the low and high end scenarios. See the bottom line there, 127.6 million to 137.8 million. These two scenarios have some common assumptions and then some variable inputs. In both cases, we're assuming 115 headcount in 2028 and 120 in 2029. Robust internship program. The places where these are a little bit, and then median PPP costs. The places where these are different is what we assume around growth in base salaries and how we scale operational investments in AI, employee development, and systems optimization. You can go to the next slide. I'll walk you through how we're proposing to assemble the resources needed to match those forecasts. We're in a process right now with the Legislative Budget Board called Base Reconciliation that'll determine the baseline amount of funding that we can request. We're anticipating that limit to be set at 124.3 million, but we won't know until probably mid-June. You can also request what are called exceptional items above your limit. Now, those go through a legislative process for review. We're preliminarily proposing a couple of items. One is to sustain the FY27 funding level forward. If you think about how our budget is stair-stepping over time, 26 is a little lower than 27. So the first item is to continue that base level from 27 forward. This is the kind of request that the legislators are very used to seeing. Second item would be the added funding to increase headcount by 5 in the second year of the biennium. That brings it to 127.6 million, which matches that low end scenario. Comes in below 9.5 basis points, which, as Bob mentioned, it continues that pattern of being a low cost provider. We should expect that number to fluctuate over time. There will be years when that is higher, but we're very proud of that distinction. Then, as you recall, that we sort of laid out a range. We do anticipate having an ongoing operating reserve that we can tap as needed to supplement appropriations. This gives you a sense of what that year-over-year pattern for the 5 years that will appear in the appropriations request look like. And we can see a steady, prudent growth over time with modest and defensible increases. There's kind of an asterisk on this, as Bob mentioned, there's some big steps that happen over the next couple of months. There's also feedback from the board, leadership offices, and if the base reconciliation process doesn't go as anticipated. But we expect to recommend something in the vicinity of 127.6. Go to the next slide. This just, for your reference, lays out some of the bigger steps. The main thing I'll note here is that we will provide you some fulsome details of the final recommendations in July, with some optional opportunities for one-on-one questions and feedback before we get to your meeting in August. That's
The part and parcel to that, we will begin kind of socializing with all the appropriate entities in and around the legislature over the first months. So we can hopefully bring you a final and fulsome and kind of pre-tested LAR for approval in August. Some outreach has already started. We met with the governor's staff last week. And as part of our communications goal of ongoing outreach with other stakeholders, beyond the board and Board of Education and legislature, we have held meetings with Texas 2036, Texas Association of Businesses, and Raise Your Hand, all to really just keep those entities updated on our progress and what we're doing as a way to just build awareness. Next kind of key steps for the rest of this year, and particularly our governance world, we will be presenting a new risk committee charter for consideration in August, and alongside of that, a draft for a consolidated budget planning and comp committee, with the idea that we have new committee structures approved and in place by December, such that in Q1, when we have new board members and new committee assignments, we can have a finalized framework there. We are, in the meantime, have been developing early days of our risk management framework through the strategic planning and policy committee. I shared with a lot of you the first cuts of just our view of risk across the enterprise and what key groups of people or companies are owners of different components of that risk. One of which is the custodial bank, and our custodial bank serves as our account of record, but they also serve as our securities lending agent, and they also serve as our investment performance source. That has been dutifully done by Bank of New York for many years. We've extended the contract to August of next year, but we think it is time and prudent now to evaluate other service providers. So at some point, over the next year, we'll be looking to approve an RFP and issue that and go out and test the market for other global custodians to re-underwrite our decision to either retain Bank of New York or to select an alternative provider. It is the staff's intention that we are going to extend that contract now, because even if we go to another provider, there will be an extended conversion period in which we will need to have engaged Bank of New York. And if they end up being the one selected, just that's what's kind of coming down the road in key governance steps for the rest of the year. Chairman, at that point, that concludes my comments.
Any questions from the board?
Marissa has a question.
Go ahead, Marissa.
Thank you so much. Bob, thank you so much for this presentation. I really appreciate it. So I think you sort of answered. I was wondering about how the projections on page 17, you talked about student population. I was curious about how those projections were influenced by the introduction of the voucher program, but I would imagine that was sort of taken into account, especially after, I think April, we started to see some of the release of those funds as families started to become notified. And so I didn't know if it was still too early to understand what that, how that influences some of the student population projections that you're looking at.
Well, I think you answered your own question there. We've posed it to several people, including Texas 2036, because of their long-term role in doing broad demographic projections for the state in all kinds of areas. That also includes student population growth. We posed that exact question to them last week, and they said it is still too early to gauge what the impact of that is. However, they are already projecting out over the next 4 to 5 years. They've got multiple scenarios, kind of a higher immigration and growth scenario and a base case and a lower one. But in almost all of those cases, it is a slightly negative student population growth. So that's the best data we have. We will continue to engage, though, in dialogue, the TEA and Texas 2036 on this, and that will be a question that we'll continue to ask. And to the extent that we actually start seeing some empirical evidence of it, we'll make sure we report back to you and the board what we see. But the short answer right now is we know it's got to have some effect, but it's too early to actually see it in any data.
Very good. Sounds good. And then the second question I had, so always appreciate that you start with our vision. I know that we have the 29 billion allocated for Texas managers. I was wondering how much of that involves the emerging managers, and wondering if and forgive me if I missed anything. I was trying to see through the presentation. I don't see anything identified specific to the emerging managers program, but if you don't have that right now, Bob, that's quite okay. I was just wondering if we could get an update on the emerging managers program at some point.
No, thank you, Ms. Perez-Diaz. We do have that.
Perfect.
And if you just give us 1 second, we've made significant progress on that, just as we have on the Texas First in the last 2 years. And we're pulling up the numbers right now. It's just at our fingertips, so it does bear.
I can give a little color in the number of meetings we've had, which are some assets, because I track this closely and I participate with Catherine in most of the meetings. Recall that we don't have emerging managers as an asset class. It's not an asset class. It is our effort to cast a wide net and to work hard to be inclusive of smaller managers that show promise. Our goal here is great returns to the school children of Texas, and we think small managers that can offer us future capacity, can grow with us, have unique approaches to the market, are valuable to us. It does take extra work, and we have staff assigned solely to that pursuit. In terms of number of meetings over the last 3 years, we have over 100 meetings per year of emerging managers, meaning funds that are early in their development, which is a significant schedule. Of those, 20% have connections in Texas and 40% are diverse. And we find diverse managers bring unique perspectives to the markets they serve. Often they have unique relationships in the market. So we do cast a wide net looking specifically for diverse managers. In terms of funding in 2025, roughly 1% of the endowment went to these types of managers, and we're on that pace again for calendar year 2026. Kind of ebbs and flows, but there is a real effort here to look for these types of managers, both Texas-based, newer managers, and specifically diverse managers, including women-led and minority-led investment management firms.
We have a count of that, though. I was just looking at it. I think the average allocation was did about 20 managers over the last 2 years, and it was roughly
I can't remember where the exact number. Some were bigger. I do know over the last few years we've allocated to veterans, we've allocated to minority-led, we've allocated to newer managers. I mean, the effort is really casting this wide net, and maybe Jared, you have
Yeah,
some
well,
totals, but.
if we could just put a pin in that, I will pledge before this meeting is out, we will come back to you the numbers, because I just had them in my hand last week, so we'll give
Not,
you the
not,
correct numbers.
that's great. And this wasn't meant for Nagacho, just kind of wanted an update on where we're at with that, because I didn't want that falling off anywhere. I appreciate
No,
it.
we focus on this, Marisa. We're proud of it. And we find some great managers, and I'd like to think we find some great managers that maybe others haven't found. And our efforts really do pay off for both Texas and for the school children as we fund newer managers who have unique approaches.
Wonderful. I appreciate that. Thank you all.
Any other questions from the board? Hearing none, we will move on to item 3 on the agenda, which is to receive a report from our general fund consultant, NEPC. And I think we've got both Rhett and Colton in here, and I think Colton, you're going to lead the presentation today. I don't know. You guys, I'm going to turn it over to the NEPC team.
Yeah, introductions here. Colton been with us nearly a decade. He's one of our senior strategists on our private debt / private credit team. I guess he's past that inflection point where we like him and he likes us. I guess he's the keeper now. So yeah, so he spent some time with John just going through what you guys are doing and sort of how we see the world. And it sounds like they're pretty simpatico. So I guess what we're going to do is Colton will spend some time just talking about the history of private credit, private debt, how it sort of got to where you are right now. And then I guess John will pick it up from there in terms of getting into your portfolio and how you can sort of expand the markets.
I think just for the board, we've got kind of two sides of this. We've got our internal update, NEPC's view. So I think anyone who's got questions on the private credit, private debt space, we have a lot of opportunities to cover.
So on the next page here, to kick things off, we thought we'd first start by level setting with our private debt taxonomy. The main takeaway here is private debt is a very diverse asset class. It's made up of a variety of different strategies, each with their own risk return profiles and rules and portfolios. On the next page, we get into the size of the market. So private debt AUM has reached over $2 trillion. Obviously a very large number on an absolute basis, but on a relative basis, it still only makes up around 4% of total global fixed income assets. So it's not necessarily too big of an outsized allocation in the overall investment universe. Next page, get into returns, and we look at it from a public market equivalent or PME perspective. So you can see here that private debt has outperformed public markets by anywhere from 200 to 700 basis points, depending on the year. There's an important caveat here, though, is private debt was largely born out of the GFC, which is why we started kind of the 2010 timeframe for these numbers. So although it has been through some challenging market environments, whether it be COVID, the rate hikes, tariffs, et cetera, it hasn't been entirely cycle tested and through a full-on recession. Next page. So I'm sure all of you are aware there's been a slew of negative press headlines around private debt in recent months. So we thought it'd be important to include this survey that Campbell Lutyens did recently. They asked institutional investors, what are your primary concerns within private debt over the next 5 years? And the way we broke out this graphic is on the left side of the page, it's more quality related concerns. On the right side is more return and activity related concerns. As you can see, the vast majority of respondents are primarily concerned with quality, particularly in the upper middle market direct lending space, which is one of the kind of largest capital areas and most competitive segments of private debt. So that's kind of where a lot of these concerns are at. And I'd say this is something that we've been highlighting for the better part of 2 years at this point. I think there's a difference between what's going on above the surface right now and below the surface. So above the surface, a lot of statistics still look pretty good. Since the rate hikes, you've got coverage ratios anywhere between 2 and 2.5x, leverage levels between 4.8 and 5x, default rates since COVID, 2 to 4% range, depending on which data provider you use for that. But all of that still looks pretty strong and conservative. Beneath the surface, it's a little bit of a different story. There's a little more smoke. So you've got stuff like PIK, payment in kind interest, that's at around 8%. The positive spin, if you want to take a positive spin on that, is it's at least stabilized a little bit. So it's been around 8% since 2024. The negative perspective on that PIK is it's double what it was pre-COVID. So it's 4% in 2019. And really that elevated amount of PIK, as well as some other features going on in the market, like amend and extend credit docs, what that's doing is really just kicking the can down the road. So GPs don't necessarily need to face their problem assets on head on right now. And because folks are kind of kicking the can down the road rather than dealing with everything up front, it's forcing kind of a lot of those above the surface statistics that I mentioned, like default rates, to probably be a little artificially low relative to the overall stress in the market, particularly the stuff that's below the surface that I mentioned. On the next page, so how does this turn into opportunities in the market right now? I just highlighted a lot of the kind of below the surface stress. That plays into special sets and stress strategies. Again, a lot of it hasn't boiled over to above the surface, but now is a good time to start allocating that space so you've got dry powder available to capitalize when that stress does start bubbling over. Because you never know how long some of these kind of volatile market environments will last. COVID, for example, was 6 weeks. So if you didn't already have allocations that space at that time, it came and went too fast for you to kind of move and capitalize on that environment. A second opportunity set is credit secondaries. There's a couple of reasons that there's tailwinds to this opportunity set right now. The first of which is private debt is now kind of mature enough that there's long in the tooth kind of portfolios and assets that's at scale to transact in this market. Seen it in private equity for decades at this point. That asset class has been around a little bit longer. Private debt's now at a point where there's enough to actually transact on this space. Second tailwind for the opportunity set here is there's just a need for liquidity across the market. From the LP perspective, a lot of folks have seen different parts of their portfolio, whether it be private equity, just not really returning capital and distributing much in the way of returns over recent years. You've also seen even kind of private debt funds on the GP side have difficulty winding down and wrapping up because of the muted M&A environment that we've been seeing in recent years. So both LPs, GPs alike are looking for liquidity solutions, again, increasing the opportunity set for the credit secondaries market. And then the third tailwind, again, tying back in the more recent headlines, you've seen BDCs and some other groups turn into forced sellers of assets as they've had to generate liquidity to fund redemptions from their vehicles. So again, another tailwind for the growing opportunity set in the space. And then the last kind of third opportunity we highlight here is opportunistic lending. I mentioned earlier, a lot of the concerns that LPs have in the market around upper mid-market lending, some of the most competitive areas of the market. We're really looking for some areas of the market that have a bit of a competitive moat. They require specialized expertise, specialized networks, and that helps you avoid kind of the negative dynamics of competition, whether it be spread compression, deteriorating credit quality, and a couple of opportunities within this theme are asset-based lending and industry and sector specialists. And then on the last page, again, not to paint too doom and gloom of a picture here, want to include another part of the Campbell Lutyens survey. They asked investors, what's your plans for private credit allocation over the next 12 months? 66% actually indicated that they'd be increasing their exposure to private debt. Only 3% indicated they'd be decreasing. So again, there's plenty of interesting opportunities in the market. There's plenty of kind of considerations you need to be aware of. And manager selection remains important, but you still want to remain active in allocating space. With that, I'll maybe take a pause to see if there's any questions.
I have one question, I know y'all have just had your big annual investment conference on this topic. Really the crux of the concerns around this tied to the amount of software lending that's occurred and whether all that's going to be positive or how it's going to shake out. Were there any takeaways from your conference, the discussion there that are we should be thinking about?
Yeah, it's a great question. It's very fair. So private markets, as you know, tends to have an outsized allocation of tech and software, especially coming out of COVID. So direct lending in particular within the private universe, largest strategy is around 40% of assets. Most direct lenders in their portfolio will have anywhere between 10 to 30% kind of tech software exposure. And those numbers, Kayleen, might be a little understated. There's some businesses that might be tech software adjacent that get reclassified, whether it be maybe a company that provides CRM systems to an industrial business. That might get classified as industrial, but really as boards, it's more software tech. So I think those numbers are a little bit lower than the actual exposure. In our view, kind of the AI disruption, one, it's going to take time. We're going to need to follow kind of the advancement and adoption of AI as that kind of flows through in preceding quarters. But also, a lot of the headlines paint it as it's going to be kind of wiping out the entire market, taking all the businesses offline, making them obsolete. Our opinion is it's going to lead to just a wider dispersion of outcomes. A lot of businesses are going to use AI as a tailwind to improve efficiency, improve margins. So there's going to be a lot of companies that actually benefit from that AI disruption. There will be some on the other end of the spectrum that get disrupted, maybe just have no kind of going reason to be kind of existing anymore. But again, it's not going to wipe out the market, and there's going to be a wide dispersion of outcomes. One other thing I'd add too, sorry, just to keep going there, but we actually identified software as a little bit of a frothy segment within private debt 2 to 3 years ago. Just seeing all the generalist capital coming out of the space where valuations were out on the equity side. So we spent time 2 to 3 years ago proactively mapping the market on ways to play offense if there ends up being volatility and disruption in the space. So we've been trying to get ahead of this for a couple of years now and identifying different strategies and managers that can really capitalize on this.
Any other questions for the NEPC team? They're not going anywhere, so we'll go to agenda item number 4 to continue this topic, and I'll turn it over to Mr. Newell.
Perfect. Morning, board members. Thanks for allowing me to be here today. My name is John Newell. I'm the Vice President here at the PSF, and I oversee the public and private debt program. We'll go through the objectives real quickly of the presentation. We want to reiterate key value drivers for the overall program. We'll highlight performance, provide an overview of the PSF private debt program, and then explain some of the key issues impacting private debt assets. This will be a little bit heavy on private debt, obviously, given some of the headlines. I think what you'll find from us is that we echo a lot of what NEPC has just said. Executive summary, the public debt portfolio's outperformance benchmark on a 1 year, 3 year, 5 year, and since inception basis. We're seeing a lot of momentum, especially over the past year in the public debt space. We think that reinforces our decision to move to an externally managed model over the past 2 years. Core private debt, that's core, has outperformed its benchmark on a 1 year and since inception basis, while non-core private debt has underperformed its benchmark over the same period. We'll touch on the drivers of that underperformance, but most of it has to do, really all of it has to do with legacy exposures. Then we'll revisit the rationale for creating the private debt program, explain why our private debt program is unique relative to our peers, give you an overview of the 3 main issues that we see in non-core private debt, and then give you a go-forward strategy for the overall debt program. Here is the team. Not much has changed over the past year since I last reported to y'all. We did have 1 new senior analyst. That's Meredith's story. I think we're in the process of giving her an offer last year at this time, so we're happy she accepted, and she's been a tremendous addition to the team. So we're really happy to have her on the team. Okay, here's the overall allocation. It's about the debt program is about 24.5% of the overall PSF. That's our policy target. We are weighted more towards the public debt side. So you see a 15% policy target for public debt and a 9.5% policy target for private debt. We are slightly below those targets by about 1% in public debt and 0.5% in private debt. I do want to say that the private debt number includes those proxy accounts that we established a couple of years ago to maintain that target allocation. And remember, as we commit more to private debt and our managers call it down, that proxy account in the PSL market will go down, and then we'll increase the actual private debt exposure we have. Okay, the next page, we showed you all this last year at this time. We always think of debt as having three value drivers. There's more, but 3 main value drivers. That's interest rates, credit spreads, and illiquidity premium. We consider that the core building blocks of the program. As you move from left to right, you can see that as you increase those value drivers, the complexity of the asset class increases somewhat, but then you get paid for that complexity. So yields increase also from core fixed income. Our target yield is about 4 to 5%, up to private debt. That's core and non-core at 7 to 10%. I think it's important to say that each of these value drivers is something can be low correlated to each other. So it provides diversification for the overall program. And you'll hear that a lot in this presentation, that we really focus on diversification. We think it's very important as debt investors to have a very diversified portfolio. Next few pages, we'll talk on these value drivers just really quickly. Interest rates, you'll see that on the left-hand side in this chart, they've ground lower over the past couple of years. That's mainly been in the short end. That has definitely benefited our fixed rate strategies. That includes our core fixed income and our high yield portfolio. On the right-hand side, you'll see credit spreads. They've been somewhat range bound, but there has been periods of volatility, especially around Liberation Day. And those periods of volatility, allow our managers to rebalance their portfolios, exit positions or enter positions where they see good value and drive excess. Importantly, credit spread volatility not only affects, interest rates and credit spread volatility not only affect the public debt side, but also the private debt side. Next page, this is the, one of the main reasons we invest in private debt is we're able to capture what we call an illiquidity premium. So that's the premium over what the public market yields will give you. It is a way to drive excess return versus public debt without taking that much more risk. On the left-hand side, you'll see that we have broken our portfolio down between core and non-core. On the core side, that illiquidity premium has declined somewhat over the past year. And then on the right-hand side, you'll see that the non-core private debt illiquidity premium has increased somewhat. I would say the most important thing to take from this chart on the right-hand side is that that illiquidity premium remains below its 5-year average. It has compressed. I think we'll talk more about it later in the presentation. We just see a lot of competition in the space, and that's part of that. Importantly, also, we still find these illiquidity premiums attractive to harvest at the PSF level. So it's still private debt still makes a lot of sense for the PSF. Okay, next page is performance. We'll start with the public debt portfolio. You'll see on the trailing 1-year basis, this is through March of 2026. It's generated some pretty significant excess returns, especially when you compare that to 3-year, 5-year since inception basis. If you remember when we launched the dedicated debt program, we actually took the internal fixed income team and moved it all external. We think that was the right decision. We think we've started to really generate some good returns there, and we've got a lot of good momentum there. So we're really happy with that. The core private debt portfolio has outperformed by 10 basis points over the trailing 1 year. Importantly, though, it's outperformed since inception by about 80 basis points. That 7.1% number is really right on top of where we underwrote the asset class. So we're extremely proud of that performance and really happy with that performance. On the non-core private debt side, you'll see that there's been some underperformance on the trailing 1 year and then the since inception basis, and we'll talk about this over the next few slides. Most of that all of that has really been from legacy exposures that we've had prior to the establishment of the dedicated program. Right. The next few pages, we wanted to reiterate why we established the debt program or the private debt program, actually. We think it's a key component in a broadly diversified portfolio. Private debt marketplace has grown significantly since the GFC, as Goldman said. It's 2.6 trillion AUM. We consider that large. The asset class has grown about 7 to 8x since the GFC. But really important here is that table on the bottom, or the chart on the bottom. Most of the investors in this asset class are institutional in nature with long-term time horizons like the PSF. So really what we were doing is bringing our asset allocation up to be more equivalent to what we see with our peers. Next page is the second reason why we started the private debt program. We were investing in private debt prior to the launch of the dedicated program. It was those investments were made by three teams. That was private equity, real estate, and hedge funds. They had three different goals of why they were investing in the space. Some of those investments were tactical in nature, some were defensive, some were return seeking. Importantly, none of them were really benchmarked to a private debt benchmark. So what we wanted to do is create some more focus and better measurement of how those allocations performed. Also those allocations were very small parts of each of those individual portfolios. So we weren't getting, if we were going to invest in private debt, we weren't getting the real return on effort that we're searching for, and we're trying to maximize those returns for the benefit of PSF. So we created one team, greater focus. Our team, all we do is focus on the debt markets, public and private. We think that's really important. And then we established a better benchmark, for which people to judge us by. You can see on the table on the bottom, in July of 24, when we launched the program, about 85% of the program was made up of these legacy investments. And we'll explain to you why that's important. But now it's about 60% new private debt investments versus 40% legacy. And you'll see that number of legacy investments go down over time as our new investments called capital, and then those old investments return capital. Right. So, talking about performance, and this is kind of a busy table, but it's an important table. We talked about underperformance. Most of that, if not all of that performance was driven by legacy investments that were from our real estate and private equity portfolios. When we consolidated those investments under this program, while it did create a fairly extremely diversified portfolio, which is great, it also created an overweight relative to our benchmark. We saw when we launched, we were about 30% commercial real estate debt. That was about 3 times the amount of commercial real estate debt in our benchmark. We also had China exposure through both our real estate, both private debt portfolio, and our private equity private debt portfolio. Legislative mandate, we wouldn't even look at China risk, and we hadn't really never done China risk outside of those two portfolios. So we had overweights to both of those. Both of those allocations, or both of those sectors, have undergone a pretty significant transition from just focusing on commercial real estate debt. It really started with COVID in 2020. It had a detrimental impact on office values, but really the real issue has been increase in interest rates since 2022, and the negative effect that's had on commercial real estate equity. But now it's kind of leaning into the debt side also. And then on China side, the China exposure, we definitely had an overweight there. That economy has obviously gone through some pretty significant transitions. And so it's been difficult in terms of performance. So looking at the table on the bottom, you'll see we'll focus on the trailing 1 year. This is through 12/31. Legacy private equity, private debt investments lost about 2.1%. And then legacy real estate private debt investments lost about 3.5%. If you compare that to what the benchmark was up 10. So that's almost 1,200 to 1,400 basis points below the benchmark, which has driven most of the performance. Happy to say that the hedge fund private debt investments have done fairly well over that time. They've done really well. And then the new private debt investments have really started to generate some solid returns. And so we're focusing on that 1 year at plus 10%. Overall, the overall portfolio has generated a 7.4% over the trailing 1 year, and then a positive 7.5% over the since inception. We think that it's important to understand that also, that again, going back to the diversification notion that we try to emphasize here, not any one bet is going to hurt us too much. And so we can stomach some of these losses in other investments if we have a diversified portfolio. Also, just focusing on the since inception IRR, even though legacy real estate and legacy private equity are going through a tough transition, you'll see the since inception IRR for the private equity portfolio, private debt, legacy private debt investments in the private equity portfolio is 6.5%. And then for real estate, it's plus 7.1%. So it's still still beneficial to the overall PSF. All right, next page, we will go through the objectives, or the next few pages, we're going to just touch on the private debt program a little bit more. We'll start with the objectives. To provide stable income to the PSF, diversify the PSF portfolio, and then enhance the PSF's cash flow profile. This page, you'll see that overall in private debt, we think we built a fairly defensive portfolio. Focusing mainly on the left-hand side here, bottom, you'll see the chart. We've broken down the private debt portfolio. This is actual dollars in the ground. When we established the program, it was 50-50 core and non-core. And so that is held true right now. We are roughly evenly allocated between the two. On the right-hand side, and we think that actually that's very unique relative to our peers and relative to the marketplace. That core portfolio, we just don't see a lot of institutions have as establishing that. So we think it's unique, and it's also been great for the performance of the PSF. On the right-hand side, focusing on sector allocation, we've got a number of different sectors in there, but I think the most important thing here to focus on is the roughly even weight between corporate lending and then asset-backed finance. I would say that we're probably overweight asset-backed finance relative to our peers, and again, we think that that's unique. But we also think that's defensive, given what we're going through, what we could potentially be going through with software disruption, AI disruption risk, like hard cloud. All right, next page. Obviously, ABF, asset-backed financing, corporate lending is a big part of what we do. The question is, why have we built the portfolio this way? Traditionally, there's been lower correlation between those two sub-asset classes. And so we like that a lot. But really, on this slide, we wanted to give you just basically a side-by-side comparison between those two sub-asset classes. Asset-backed finance, think of it as lending to a very diversified pool of collateral. So a number of different assets are in a pool, and you can lend against that. So not any one asset in there the thought is that it can really hurt you. Repayment is supported by those specific assets, and those specific assets are backed by really hard collateral. So you can think of equipment leases, you can think of aircraft leases. And so they're just hard collateral. So we like that a lot. They also are long-term leases. They produce predictable, stable cash flows. And then because of the hard collateral behind that, you typically see higher recoveries versus in a default scenario than what you see. In terms of corporate lending, it's different. We still like corporate lending a lot, obviously. But we do have exposure to one single corporate borrower, not a pool of assets. Your repayment on your loan is typically supported by the enterprise value of that business. That enterprise value is driven by the cash flows tied to that business and its corporate earnings. So it's definitely tied to the business side. Because of that, we typically see lower recoveries in corporate lending than what we see. Also important to highlight, and I think we talked about it earlier, we think that asset-backed finance has just lower technological change or obsolescence risk. So very important, given kind of this transition that we're all going through here, that no one really knows how it's going to turn out, but we'd like to have our clock behind us. All right, next page, just to finish up on why we really like asset-backed finance, and also corporate lending, but really asset-backed finance. It's just a really big market. It's $20 trillion that you can see that on the bubble on the right-hand side. Leverage finance market's about $3 trillion, so it's about 7 times the size. It's huge. Really important though, is you can see in that green bubble, on the right-hand side, there's only $500 billion dedicated fund offerings that prosecute the asset-backed finance market. So the penetration rate there is 2.5%. So, like Colton was talking about competition between lenders, we just see less competition in asset-backed finance. And it's, and there's a lot of white space for managers to basically to lend against and to basically build durable return profiles in that bucket. Compare that to corporate direct lending. It's almost over 50% of that leverage finance market. So again, a lot of competition, a lot of lenders, seeking out borrowers. Look, there's been a lot of money raised in the space, and we'll touch on it in the next few pages. But competition is important when we lend money. I don't know about you all, but I'd rather have 20 different lenders competing to give me the lowest rate, the best structure, and the lowest amount of covenants, because I just feel good about that. And so that's essentially what's been going on. So we like asset-backed finance. All right, next page, we'll quickly go over the core private debt portfolio. Again, this portfolio is designed to produce stable yields and returns. Importantly here, it's a 4.5% strategic asset allocation target, and that's fully deployed. So we put that money to work. Our managers put it to work. It is producing stable returns. Really happy with that. Again, this core portfolio is investment grade, rating span from single A to triple B. It does have a higher concentration to asset-backed finance, and we like it because it's floating rate, short duration, helps in a potentially increasing interest rate world. But it also targets an attractive yield for the overall PSF at 6 to 7%. Next page is the non-core private debt portfolio. It has a 5% target in the strategic asset allocation. We're about 1% below that target. I would say really the important thing here is we talked about the legacy exposure. We've made new investments. But only 35% of our new commitments have actually been deployed. So we've got about 65% of our commitments still waiting to be deployed into what we think could be a more volatile environment in markets. So we have a lot of dry powder to capture that dispersion and that volatility. So we think it's a great place to be in this portfolio. We think it does have a posture, but also an offensive posture to prosecute on. This portfolio, you'll see, has a higher concentration to corporate cash flow lending. It is still primarily floating rate in a short duration, but you can see it does target a higher yield of 8 to 10%. That's because it has the ability to move more up and down the capital structure to see what is the best risk-adjusted returns. Okay, next page, talking about, we're just really putting some numbers behind that dry powder. So, we think that dry powder is a really important thing to have, especially on any potential volatility that we might see. Since inception, you'll see that we've made about $3.9 billion of commitments, but only we'll still have $2.6 billion remaining to be funded. So that's really important. We think that, given everything that we just talked about in private debt and what we'll talk about in a few pages, that's a great place to be. Really happy. Okay, next few slides, we're going to go through kind of the three main issues that we see in private debt and issues that we're monitoring. That's a great AI generated picture of me on the right-hand side. So, I don't have the time, but AI is a powerful tool. But most of the stuff that you read in the headlines have really to do with what we consider non-core private debt, so not really in our core private debt portfolio. Again, we have a 5% strategic asset allocation to non-core private debt. So we haven't really bet the farm on non-core private debt, but it is an important part of our portfolio, and so we wanted to touch on the issues that we see. And they'll echo, I think, a lot of what Colton has been talking about. Issue number one, seen a tremendous amount of flows into direct lending. Look, I want to preface these comments with, we like direct lending. We do direct lending. We think it's attractive, but it's attractive at the right price. Direct lending is about 29% of the overall private debt universe. You'll see that $580 billion have been raised in that space over the past 5 years. And on the right-hand side, in that bar chart, over the past 5 years, every year of capital flows have been above the 20-year average. So a lot of money has been flowing into that space significantly in that 2021 vintage, where you saw a lot of software deals getting done. But you also seen it in 2024 and 2025. And really that's on the back of the golden age of private credit, whatever that means. But interest rates going up and base rates, and these are floating rates. So a lot of money is poured into that to take advantage of that. I would say important for this meeting and for everyone to understand, our non-core private debt program is significantly underweight direct lending benchmark. We've taken an opposite route. I think it dovetails with what Colton said. We focused a lot more on being opportunistic in the space, potentially cleaning up some of the issues, and taking some of the original lenders out of their problems over the next few years. So we think that being opportunistic is an attractive place to be, and that's how we've built our portfolio. All right, issue number 2. We think there's a pretty significant asset liability mismatch in these retail focused structures, not in anything that we do, but it is an issue. Retail is about 15% of the global private debt AUM. That means it's about $400 billion. So that's a lot of money. Most of it's been raised, if not all of it's been raised in public BDCs, private BDCs, or semi-liquid funds such as interval funds. And almost all of it is doing direct lending. So we talked about a lot of money going into direct lending. A lot of that money came from retail-focused investors. I think it's important to understand that we view private debt as private, and we're private investors in this bucket. We're taking long-term views, and we put money in the space knowing that we're probably not going to get our capital back for another 5 to 7 years. We don't expect it to come back within a day. Some of these structures, especially public BDCs, they allow you to get your money out in a day just by pressing a button, and that's powerful if you're the only one doing it. But if you have a lot of other investors trying to get their money out, it can create a lot of problems. And that's not just public BDCs, that's private BDCs with gates and semi-liquid funds with gates. In our opinion, that creates a very significant asset liability mismatch. The assets have a 7-year duration, and the liability on a public BDC is daily. And so that's a problem. I personally, and I think I talked to you all about it last year at this meeting, I've lived through that. We had a pretty significant asset liability mismatch at my firm going through the GFC, and it was scarring physically and emotionally and professionally. And it was just very tough. So everything that we do when we invest in this space we focus a lot on asset liability mismatch. It's extremely important. It's also important for the space, not just our portfolio. When investor capital gets locked up, that creates a giant sucking sound in terms of capital that's available to borrowers. And we'll touch on maturities on the next page, but if there's not as much money in the space, but there's a lot of borrowers needing to refinance their capital, that can create a lot of problems, and that can create a tough refinance environment. It's actually good for us, I would say, just because we do have a lot of dry powder in the space. And again, we're trying to be more opportunistic at this point in time. Important for this also is that we have no exposure to any of these public or private semi-liquid BDCs. We just chosen not to do it. We did not want to that asset liability mismatch problem. Okay, next issue and last issue here. I talked a little bit about it, but it's software exposure and AI disruption risk. We've all heard I think we've all heard it, but I think it was Martin Andreessen. Software is going to eat the world, and frankly, I don't think that's changing at all with what's going on. It's just, is it going to be AI or is it going to be software companies? Software companies have been an extremely attractive sector to invest in over the past 15 years. That's across public equity, private equity, direct lenders, and also BDCs. these are very solid, these have been very solid business models, very recurring revenue focused, high margin, high growth. People see those fundamentals, or investors see those fundamentals, and they salivate. We saw that in 2021 after COVID. Everyone thought the world changed. Interest rates were zero. We saw software valuations, peak at maybe sometimes 25 times, which is huge. And I think that was even 25 times revenue, so not even earnings or EBITDA. And then we saw a lot of deals in the space by private equity, but also direct lenders finance those deals. So, there was aggressive structures and aggressive valuation multiples at that space, in that space. That's now those business models are now under significant threat from AI disruption. So that can create an issue, especially for that 2021 vintage. You'll see here on the maturity wall on the right-hand side, there's a lot of software loans coming up for maturity in 2028. And then even after that. So we're going to see how that all plays out. But it could create a very significant and tough refi environment. We think there's going to be a lot of dispersion in outcomes. We think there's going to be a lot of volatility. Importantly for this, our non-core private debt portfolio has less than 5% software exposure. And if we think about AI disruption risk, it's probably 10%. Multiply that 10% times 5%, it's about 50 basis points. So we think we've done a good job not drinking the Kool-Aid, I would say, in software. We saw a lot of managers come through our office and just say, software. We just could never get comfortable. We never did a dedicated software fund. Just we believe in diversification, just didn't want to do it. Okay. I know we've talked a lot about private debt and software exposure, but we also see a lot of software exposure in the bank loan market. It's about 17% of the benchmark. So that's information technology. So software is a part of that. So it's definitely a component of the benchmark. Bank loan market has been an outlet for software financing. We use bank loan pricing to kind of determine or think about where private software loans should trade. It's been all over the map. Some software companies, their loans are trading down 40 points since January. Some are down 2. Through the first quarter, net, I would say on average, software loans are down about 7 points. And I think that's actually rebounded a little bit, but there's just a lot of dispersion in the space. And so again, we think about that as a potential leading indicator of direct lending performance. But again, down 7 points. How much of that is just panic? I'd say important for us. We have a bank loan portfolio. Software obviously is a big part of that book. We were down about 1% in the first quarter. Again, showing the value of having a diversified portfolio and not taking this back to credit. Okay. Talking about defaults, like Colton said, there's been a lot of noise at the top, but underneath, there's been a lot of, it's kind of glossing over some of the things that we see underneath, and that's default rates also and the amount of PIK. But you can see that default rates have increased, especially pre-GFC. You saw it during the GFC spike up significantly, then go down, and then increase a little bit and come down. And this is both for private debt and BSLs, broadly syndicated loans. I think the way that we view this is right now, this is more a normalization of default rates. If you think about what happened at the GFC, 2008, interest rates went to 0 or 1 to 2% for about 15 years, essentially. And that created a lot of companies. It gave a lot of companies the runway to just continue and not default. So we think that, what we've seen since interest rates have gone up in 2022, time has run out for some of those companies. And so you've seen default increase. I know it's gone down a little bit. I think that, we would expect defaults to pick up a little bit more. And I think a lot of the industry research would say the same. But again, we think that this is manageable. We don't think it's an existential problem. All right, finishing up the presentation. just want to give you an overview of what we're focused on. I'd say the three most important things from this page. On the left-hand side are the artificial intelligence build-out, artificial intelligence disruption, and then geopolitical. The spending on AI is crazy. It is, a lot of it is from, these hyperscalers, extremely high-quality investment-grade companies. I think in the first quarter alone, the CapEx spend from those companies went from $1 trillion over the next year to 1.6 trillion. So that's $600 billion in one quarter. That's a lot of money. They need to finance that somehow. The question I think for us is who's going to get left out, because there's only a finite amount of dollars that can be used to finance this. So it creates some dispersion as we move forward. Again, we think we're at a pretty good spot. We've got a lot of dry powder. So we'll see how that plays out. We've talked about artificial intelligence disruption and software. That's the main topic. And then geopolitical, Bob touched on it also. It's created a lot of volatility. I think the biggest risk from geopolitical, and this is mainly the conflict in the Middle East right now, is the effect that it's going to have on inflation, interest rates, and growth. We've seen inflation expectations in the short end kind of go up. We'll see if that filters out to longer term expectations. That wouldn't be good. And how that would affect interest rates. Interest rates going up in a floating asset class such as non-core and core private debt is good up to a certain degree. High interest rates are as we've seen kind of with default spiking, create problems. And then you factor in the potential growth coming down. It's just tough for any asset class. So we're really monitoring, including core fixed income and equities. So we're monitoring this. I think we're set up fine, but we'll continue to monitor. Okay, finally, finish it all up. Here's our AI generated picture again. He's hopeful.
John, what was the prompt for this one?
I don't know. I can't remember.
Basically looking into the.
Well, you should have seen the first one. It was he didn't look that good. So the color to make it a little bit more attractive and unlike the picture that I gave him of myself. So look, hopefully you all understand that. Look, we're trying to be respectful of markets. We in private debt, we see what is going on with the BDCs. It's important. It's an important data point. Try to filter out signal versus noise. We think that's a pretty good signal. And so we're trying to respect it. But again, we're long-term investors. We want to look to the future. We want to be patient with our capital. We've got a lot of dry powder out there. I think our managers, talk to them a lot and we try to understand what they're doing. We don't tell them exactly what they have to do, but we make sure that we're aligned and that we just want to be patient. And I think they are. We're also keeping an eye on liquidity. We know what the debt program, its role is at the PSF. Again, we just want to focus on the long term. And that's it. And if you have any questions, please feel free to ask.
Any questions from the board for John?
I have one, if you can hear me.
Yes. Yeah, we can hear you. Go ahead.
Can you just talk big picture, private credit versus, I'm familiar with bonds, not as familiar with private credit. You talked some about the tenor. So when do you get the principal back? Could it be paid off early? Could it be extended? Talk about liquidity and kind of how you get paid in terms of, is it an annuity? And then when you get the principal back,
Yeah, a lot of private debt loans have a 7-year tenor to them. So we collect our coupon and then get paid back at the end of that tenor. Usually you see private debt priced to like a 3-year hold. And that has a lot to do with who we're financing and the momentum of money in private equity. So what we've seen is, with private equity having its own issues, not a lot of deals getting done. Maybe those deals staying outstanding for a little bit longer. That 3-year hold is going to 5 or even kind of 7 years now. And so, it's definitely extending a little bit longer. But you compare that to broadly syndicated loans, it's roughly the same thing. High yield is fixed rate, not floating rate. So it's a little bit different. But, the sponsors are pretty good with liability management. They always want to lower their cost of capital, and they'll call their loans at certain times to make it more attractive to them. So it's kind of all over in terms of tenor and duration.
And is PSF a direct lender, or are you investing in a fund, or?
Oh, no, we invest in funds. So
Okay.
yeah, we give it to direct lending managers or private debt managers that, they go out and make the loans themselves and take all that into account.
Okay, got it. So you're kind of blending this, you're blending that risk over a number of loans.
Yes, definitely. Again, we're very focused on diversification. We definitely blend that risk.
Okay, and last quick one, is there any prepayment penalty for these debtors?
Well, there's sometimes, it all depends on how the loan is structured. You can structure in maybe a minimum MOIC, which is a multiple on invested capital, if they prepay. So you can say, look, if this is a 7% type coupon that you owe me over the next 7 years, if you refi this in the next 2 years, you're gonna pay me like 1.2. So you're getting the benefit of them prepaying. So that's all in the structure.
Okay, great. Thank you.
Yep.
Any other questions? Hearing none, I think we're gonna circle back quickly to the question on emerging manager data. So I'll turn it back over to Bob to address that.
Thank you, Mr. Chairman. Marisa, we have had time to find the report I was envisioning. So I think this will shed a lot of light on your question. Prior to the corporation being launched, I think the PSF had established an allocation of 1% to emerging managers. And that resulted in, over time, about $400 million being allocated to 15 managers, an average allocation of about 25 million per manager. Since we adopted a new plan in the beginning of 2024, one of the things we did was not try to put it in allocation because, as Stu pointed out, it's not an asset class and that's not the appropriate way to model it. That might have caused some concern that was a way to not emphasize this program. But in fact, what has happened since then is we've placed about $1.5 billion with 19 managers for an average account size of 75 million. So that is almost a 4x increase in the amount of capital that we've put towards emerging managers and a tripling of the average award size for each of them. And now we have approximately 3% of our assets being managed by emerging managers.
Sorry, I was trying to come off of mute. That's great. Thank you so much for that update, and I appreciate you taking the time in the middle of the meeting to go through that. I didn't expect that, but thank you so much, Bob. I appreciate that.
No, my pleasure. And it's just prompted us to include in some of our regular reports about, things like the progress on Texas First, because Texas First is the same thing. We're not setting aside money. We are just using an eye towards in our due diligence process when we have these opportunities. And the same thing is happening in emerging managers. So we've been able to significantly increase the program while at the same time, maintaining really high underwriting standards. So
thank you.
Okay, we will move on to agenda item number 5. We already covered relating to personnel matters. So we'll move on to committee reports. Agenda item number 6, Budget and Compensation Committee. Starting with myself, the Budget and Comp Committee met last week. All members were present. We covered the new draft risk and investment management report that was very thorough. I think all the committees received that. Then we covered compensation for the team and the CEO. If you recall, the compensation process has been evolving over the last couple of years, trying to focus on being market-based, pay for performance, but that's a a process to kind of get us closer to the market. So that is progressing. We're fully in kind of a normal cycle on that now. And then the last topic was the budget and the appropriations process, which we also covered here earlier. With that, I will turn it over to Chairman Kinsey on the strategic planning and policy committee. You're on mute.
You're on mute.
How about now?
Good.
Thank you, Mr. Chairman. Met on Wednesday, May 6th at 2:30. Let's see. Two of us were present. We talked about the corporation's risk management framework with Bob. We also talked about next steps possible for the board to oversee critical investment risks that we face. I think you just mentioned that as well. So I think this was covered in all three committees. But we had a discussion on the 5A endowment spending rate and the 5G supplemental distribution for 28-29. Talk more about methodology for the ASF distribution and some of those preliminary inputs that we talked about earlier today. Jared Stout walked the committee through the performance management report for Q4, and then we got an update from Needy, the COO, on the strategic plan. She noted that the strategic plan refresh in December 25 revealed the absence of centralized framework to measure the progress and impact. And so the organization is now transitioning from a completion-based reporting to a more data-driven approach to better measure performance through a KPI framework. Meanwhile, staff continue to make progress against the strategic plan, including spearheading their AI initiatives, strengthening employee engagement, and bolstering partnerships with Texas universities, building intern class. The committee reviewed the remaining 2026 agenda planned agenda for the committee, and then we adjourned.
Thank you, Chairman Kinsey. Chairman Ellis, report from the Audit and Ethics Committee.
Yes, sir. We met also on Wednesday, May 6th. We had myself, Member Hickman, and Member Maynard in attendance. We also received remarks from Bob Borden, as you had mentioned previously. Next, we had Fernando Garza, our Chief Audit Officer, inform the committee that the state auditor's audit of the Bond Guarantee Program certification and the comptroller's desk audit came back satisfactory, and there are no past due audit issues. In the internal audit of the investment contracting and regulatory reporting, the RSCA, and what that is for those who don't remember when we discussed this earlier, is a balance between risk and impact in prioritizing those audits in that fashion. And the finance RSCAs are ongoing and to be completed by June. He also shared that a new auditor joined the team in April, and the internal audit team is now fully staffed. And then we heard from Lane Arnold, our general counsel, updated the committee to say that also his corporation's legal team is fully staffed, and they have added a compliance officer and 2 investment attorneys to round out the team. And he also discussed the director's referrals, which if you're interested, you can find in your diligent board book. And we went over a quick summary of the agendas for the next 2 meetings and adjourned.
Chairman Ellis. Agenda item number 9, we already covered. Agenda item 10, last but not least. Back to you, Bob, I think on future agendas, if there's anything up there.
I've touched on most of them. We've got 2 regularly scheduled meetings. I just want to highlight the things that will be approved. In the next meeting, we will be doing a review of a private equity program, but we will have the LAR up for approval and the 5G supplemental up for approval at the next meeting, as well as the first review of the committee charters, and we'll lay out a plan for how we're going to address the custodial bank issue. And then in December, we've got real estate and real assets infrastructure for report, but no heavy approval items scheduled right now for the December meeting.
So Bob, I think Mike mentioned this, but ahead of the August meeting, as people think about and digest the LAR and those points, the committee or the team, we can figure out times, but just sort of include that in your summer plans as a little bit of mind share on the budget and the LAR before the next meeting. Happy to do ad hoc calls or whatever's helpful.
Yeah, correct. We basically have identified what we think our incremental spend is, but we've got to get the information on what the state considers the base budget. And with those two pieces of data, we'll confect the official LAR. And we'll communicate with y'all what those numbers look like between now and the meeting. So you've got some preview for this and hopefully make the approval process pretty streamlined at the August meeting. That's all I have, Mr. Chairman, on future agendas.
All right, thank you. Anything else from the group online? Meeting adjourned.
One quick one for me.
Oh, sure, go ahead.
Yeah, I just see December, there's committee charter action. I, for one, am a short timer, so I don't know if you want me determining the committee charters or if you want to do that in January or February when the new board comes. Just something to think about.
I think we can take that away and back to the group. All right, thank you.
Thank you all.